All right. Welcome, everybody. A little bit of a different format this week. As you can see, we are on video, and hopefully, you guys are watching this before our next lecture. This week, we're talking about valuation. Very important. This is, I would argue, the meat of everything we've. This is just the best part, right? And but yeah, today I'm here with David. We're going to be walking through
Hello.
valuation. He's on the cursor there, so you can see every one of his keystrokes here. Um, but yeah, with that, we're going to try to break it down nice and easy, provide a lot of examples, and really understand time value money and the second half of our income statement or of our model there. So yeah, today's agenda, we're going over time value money, given background, just very basic background, time value money. Cash flow analysis, and then return analysis. We will not be hitting sensitivity tables as it would just be too much to go over in one setting. We'll cover this all, and we'll also upgrade to the Greg model so that everything ties in together. But yeah, with that, we can jump right in to our very first example of time value of money. Right? Let's say you have $100. I'm sure we all got $100 sitting somewhere. There's three options we could do with this $100. Option A, we could do nothing. Option B, we could invest. We're very intelligent Emory students, and we know we could go to the S&P 500 and get a yield of 5%. That's $5. Let's just say our timeline's a year for all three scenarios, right? That's $5 I made that year. Incredible return. And then option C, we could spend it. That's, I feel like, a little bit more congruent with Emory students. But yeah, we could spend that. We could go from 100 to 0. But let's focus on option A and option B. If we invest, you can see we're making that $5. If we do nothing, there's a cost associated with it. What is that cost? That's the $5. The cost of not doing anything is going to be that return on the S&P. So very clearly, we have two concepts that are going to be very obvious to us here. Right, so there's a clear cost associated with the timing of cash flows, right? Say we flipped the script here and say we are receiving the money rather than, we don't have the $100, we're going to receive the $100. Let's just say we were going to invest it regardless. So if we received the $100 today, we could invest and get that full $5. Let's say we received it a year from now. We're not getting shit. We're just getting $100 there, and we lost out on the $5. So there's a clear opportunity cost associated with the timing of cash flows, right? So cash received earlier is more valuable than cash received later. And then the second concept here is that when we're comparing our investments, we're looking at an alternative set. We're looking at all of our opportunities that are available to us. We're going to compare them across time, and we're going to see which one is best and most valuable to us. So with that, we could jump right into our very first tool, and that is, David, next slide, present value. Now, you probably saw this on the Excel lecture. This was on task number 9. We had present value, future value, and net cash flow, net present value, IRR, all that stuff, right? So we'll start off with a very simple example, right? Example 1. We inherited a brokerage account from an uncle, with an unknown sum of money. The portfolio generates 6% return each year, and in 5 years, we want to liquidate the account to discover it's grown to $41,650. So we want to figure out how much was it worth 5 years ago, right? We're going to be doing a little bit of time traveling here, but let's just say we knew the future value of it, which is 41,650. We want to know the present value as of today, right? Think of inflation, right? That's always growing. Our value is changing regardless throughout time. So we want to figure out, what is it today? So we're going to use a very simple formula right there on the right hand of your right hand side of your screen. Present value is equal to the future value, that future value being $41,650, right? Divided by 1 plus our R. Our R in this case is our discount rate. We're discounting it back into present value. Now, what can be a discount rate? Let's think of that opportunity cost, right? Remember that 5%? The cost of doing nothing is 5%. So there's an opportunity cost, that's the cost of time. So we're going to discount it by the cost of our time, which, let's just say, in this example, it's 6% because the portfolio is generating a 6% return. So we're going to use that $41,000 as our future value, right, as David's right now, divided by 1 plus our R, which is our discount rate of 6%, right? And we're going to raise that by the amount of periods we have in our timeline. So we're going to raise that to the 5th power. And that's going to equal David, if you
Ooh,
would do the honor
I'll have to
of.
calculate that.
There we go. You forgot to
So
calculate it, but it's all right.
41,
So we'll do it
650.
together. 1.06, right? And oh 06. Raise that to the fifth power. Let's see here. That is 1.06 raised to the. Come on, phone calculator. Okay, hold on.
Mine is showing 31,123.
There we go. 31,000.
But again, I'm using an iPhone calculator, so that might be wrong.
Yeah. You can no, it's that's correct. It's just I had to turn off the damn the iPhone lock? You know, when
Oh
you
yeah,
lock your
yeah, yeah,
phone? Yeah,
yeah.
yeah, yeah. So I couldn't access my
You don't get
damn.
the juicy buttons.
I know. The best part of the calculator.
Hmm.
Anyway, there we go. We have the present value. That's crazy. Look at that. 30 that our little portfolio there was worth $31,123. 5 years from that deadline, from that liquidation.
If your present value is higher than your future value, that's how you know you did it wrong.
If your present value is higher than yeah, you did it wrong if your present value is higher than your future value. That is a good point. But sweet, yeah, we're just very simply looking across time. We'll develop these concepts a little bit more when we look at our model, but just very simple. We're just trying to understand how does money move through time? What are the different formulas we use? So our next example, and I'll pass this off to David, is going to be future value, our second tool.
Hmm. All right, so future value is really the same thing, but we are taking the same equation and flipping it. So in this scenario, we would know what our present value is, PV, but we want to know what our future value is. So let's do an example of that kind of problem. So example 2, say we have $13,500. So PV would be 13.5K. We want to invest that over 2 years. So our time horizon is 2 years. And our first thought is to take this to the market and receive a 5% return in a market portfolio, something like an S&P 500. Alternatively, our friend, we'll say it's Mason, and Mason recently opened a cafe and he is looking for an investor. What's the minimum amount of return that my friend Mason must promise me in 2 years to convince me to invest with him instead of the S&P 500? So really this question is asking, what is our future value, right? How much money am I going to make with a 5% return every year over 2 years with the S&P 500? And if Mason pays me greater than that amount, I will invest with him. And if Mason promises me a return that's lower than that future value, I know it's not worth it. I would rather invest with the market. So let's go ahead and do that. So future value is unknown in this case. So then what we would do is take our present value, which is 13,500. You want to do the math while I do this,
Yeah, I
Mason?
gotcha. Yeah.
We multiply that by, or I guess I can write it like, oh dear. All right.
Oh, that's beautiful.
Times 1 plus our rate, growth rate, which is 5%, 0.05, raised to my, oh man, my period, which is 2 years. This is so ugly.
All right, so your multiplication is okay. There we go. Okay, I see. I see where the mistake.
Mm-hmm.
That's time. Okay, 13,500 times one plus. Oh, all right, I got you. Raised to the second power.
Uh-huh.
That's going to equal
What is it? Uh-huh.
$14,883.
14,883. So that's my future value right here. Boop. So now then I can make a informed decision as to where I should invest my money. So anything that is below 14,883, I'm better off just taking it to the S&P 500, making this 5% return. If it's greater, let's say Mason's like, oh, in 2 years, don't worry, I'll give you $15,000, and that'll be like your cash out. Then I know I'll make more money with Mason. I'm better off investing with him. So future value is very useful using in stuff like this. So here's a great example of a future value formula in use. You've already used it, you just don't realize it yet. So in our model, if you remember when we walked through in class, we knew our year one value, right? That was given by our assumptions. However, everything here we had no idea. So what we had to do was derive it by using our current value and then using a future value function or calculation according to the growth rate that we were given, which was 4%, I believe.
Yep, I think
And
so.
so, PV would go right here, 60,000, multiply that by 1 plus 0.04. And then our N in this case, we're just finding the next year over, so it would just be 1, right? So in reality, in that case, if it's just a single year, you don't even have to write that, you know?
Yeah, so our present value is going to be moving, right? So this is a dynamic thing. So
Mm-hmm.
that's why,
And then you're going
the
to
one.
do that calculation again and then again, and you just drag it all the way across.
Yeah, so year three's calculation is going to take years two present value. So that's why
Mm-hmm.
we're not doing that, raise it to
Exactly.
the, yeah.
Yeah.
Okay, sweet.
Cool.
So moving into cash flow analysis. This is our second building block. So building block one, time value of money basics. We got two tools, present, future value. Now we want to see, what do we apply this to? How do we apply our time value of money? And we're going to apply it to our cash flow, right? So how do we arrive at our cash flow? Remember NOI, right? We did a very simple calculation. We took our operating revenue minus our operating expenses. Remember, we broke down the income statement. We had arrived at EGI, effective gross income, subtracted out our operating expenses, remember, taxes, insurance, various expenses like those,
Mm-hmm.
and we arrived at NOI, net operating income. Now, this is considered above the line, NOI being the line. Now, what goes below the line is items that are not considered operating expenses. These are items that you choose through your business plan. So, for example, CapEx is a very common uh, non-operating expense, and essentially, what CapEx is, let's just say there's a renovation needed at the property, or you want to do an addition. Our value add strategy. Remember, this is a very important part of our business plan. Non-operating, it's a one-time thing. So let's just say we have to repair the roof, right? That's a one-time thing that doesn't happen very often. You could own the property and never repair the roof. You could transfer it to the next guy and he'll have to repair it. But this is something that you could add into your model, right? And that's another thing that David wrote, new pool, value add, right? So these are all CapEx. These are spending, you're spending on things that are either repairs, major repairs like the roof, or additions.
Mm-hmm.
So very much non-operating. And that's one example. Another example of non-operating expenses are tenant improvements and leasing commission or leasing costs. They could be called either one. But the thing is with TIs, and I'll explain what TIs are here. So if you think of tenant improvements, think of a 5-year lease with a Kroger. Kroger is there for 5 years. We're up at year five. They're leaving, and they're gone. Publix then comes up to us. We're like, hey, we like this space. We'll do the negotiation. We'll sign a 5-year lease with you. However, we want some TIs, some tenant improvements, and that we want you guys to, for example, we want you to put up the sign. We want you to set up the shelves, right? And that's going to cost the owner of the property that TI cost, right? So that's part of the negotiation, in that we could attract a tenant, right? So vacancy is the number one cost. TIs are a great uh, point to where
Incentive.
you could give up a little bit, just to have that tenant, to avoid that major vacancy cost. And then leasing commissions, we have third parties, we have brokers. A leasing broker is very common. They found you Publix. They found Publix to rent into your space. So we have to pay our brokers. Unfortunately, we pay them a little bit too much. However, we still have to pay them. So that's going to come out through leasing costs. And these are very one time, like I said, every 5 years. Broker was there for 5 years. It's very non operating, it's a one time thing. So these are all below the line. So now if we go to the next slide here, we could see our final calculation. If you go to our model, we have NOI minus our CapEx to go into net cash flow. You could call it net cash flow as adjusted NOI. You could also call it unlevered cash flow. These are just other names for it. And what we'll do real quick, just so that we're keeping consistent with the model, David, if you could switch over to the Excel real
Mm-hmm.
quick. So you can see our Excel here. And just like before, like every other item on this, we have our assumptions. So we're going to go to year one for CapEx, and we're going to reference our CapEx per square foot over there at D18, I believe. And we're going to multiply that by our square footage up at the top. So we can get our total CapEx, and that's going to be $5,000. Now, remember our future value formula. We're growing things into the future using an assumption, our growth rate, and we're going to take our previous period, multiply that, grow it up by 2% each year, right? So you can see we're keeping year one dynamic so we can move it across, and we're also locking in our
Mm-hmm.
CapEx
This
growth
would
rate.
be technically raised to the first power, but we don't need to write that because it's just 1 year.
Yeah, and another thing that we could do is let's just say we locked in our year one. If we were year four, right, we would have to raise it by the fourth power.
Mm-hmm.
It's all relative to what year you are locking in. And since we have a moving present value, we don't have to worry about that, right? So we're keeping it simple for ourselves. But yeah, we could move beyond that. Let's look at net cash flow. Very simple. We're just going to take our NOI minus our capex, right? There's so many other line items that could be between NOI and net cash flow, but we're just keeping it simple with just capex. So let's do that. Subtract it across, and you can see that is how much money we are taking home after those implementations of our business plan, right? So you could call it net cash flow. You could call it adjusted NOI. You could call it unlevered cash flow, as you can see there with that David's typing in. But with that, let's jump right back into the presentation. And there we go. All right, and we're back. So the next thing we have to really consider, right? So we talked about cash flow. We talked about our intro time value money. These are our first two building blocks. Now we want to figure out what is our next question. What questions do we want to be asking, right? So how will our cash flow look in today's value? That's one thing. This is all in future value. So how will it look like? What will it look like today? Is the present value of my investment greater than my alternatives? That's our number one question. We want to see, is this our best choice for our money, for our investment today? So with that, we're going to go into valuation and complete the puzzle. And oh yeah, sweet. There we go. So when we think of the model, right, we
Whoops.
are going to, there we go. When we think of the model, we're really going to break it out into three main components, right? So what you're looking at is, this big drawn out formula, but this is you could think of it as a representation of what our model is doing, right? We have three components. Component one is our purchase price, right? So C0, right? You can see it's a negative. That is our outflow of cash. We used our equity to purchase the property. That's going to be that outflow, right? So that's number one. Number two, we have all those cash flows. And David, if you go to one down, next slide, next slide. So you can see that unlevered cash flow line item. So from 34,000 to 41,000 there, David, if you could underline it. Uh, this is all, yeah, right there. That is all our cash flows. We want to see what that looks like in present value. So that's the next part of our formula. And you can see the outflow of 600,000, our purchase price, it's right there. So that's one and two, right? And then number three, if we go back, just one more, this one's going to be a little bit confusing. We don't have to worry about Gordon growth. So that formula there, if you've seen it before, if you understand it, that's perfect. We're not going to be dealing with that. We're going to be taking it a little bit more of a simple approach through cap rates. And we'll figure out through cap rates our sale value, which is our third component there that David has circled on the right-hand side. And with that, I'll leave it to David to explain cap rates. But yeah, this is a little bit tricky as well. So
Yeah. So I think the Gordon growth model, you'll probably talk about it if you are taking Sergio's real estate finance class. It's just a method of valuing something with steady growing cash flows, which you could argue that this is. It's very common in valuing like dividend paying stocks, etc. But usually on a day to day practical level, you'll probably encounter more often something called a cap rate and valuing your property using your cap rate, right? So remember, the value of your property, an income generating property, is directly tied to its ability to generate the income. So the more cash it generates, and given the same cap rate, the more valuable it is. So what is cap rate? Cap rate, you can simply kind of think of it as a real estate industry specific term for something else you've heard before, which is ROI, return on investment. So the calculation for cap rate is your NOI divided by your property value, which is what? What percentage of my purchase price that I've spent am I getting back every year in terms of my net operating income? So, if I spend $1 million, 1 million, and my NOI is 50K, my cap rate would be 5%, right? That's my real estate kind of world's ROI, right? So if we know this cap rate and then we don't know our NOI, or we know our NOI but we don't know our property value, we can find either one. So it's very, very valuable and useful. Okay, so let's go through an example, right? So in scenario one, I'm buying a property with an NOI of $10,000, right? You see right here. And by the time I sell it, it is still $10,000. Nothing has changed in terms of its ability to generate income. I didn't raise rents, I didn't do anything. However, you see my value went up from 100K to 150,000. How is that possible? Well, that means my cap rate has shrunk. So I bought at a higher cap rate, I'm selling at a lower cap rate, and therefore I'm getting more value from the property, right? So it's kind of a backwards metric right here. You can see. Usually you want to, in terms of like a dollar figure, you want to buy low, sell high, right? You want to buy stock at $20, sell at $60. Cap rate is kind of the opposite. You want to buy at a high cap rate and sell at a low cap rate. So buying at a high cap rate makes sure that you can buy it for cheap. Selling at a low cap rate means you can sell it for more money. Okay, so how does this happen where my NOI doesn't change but my property value went up? Well, it could be that I did some other means of adding value to the property. For example, through CapEx, right? Maybe the property is more attractive despite the same income generation based on the fact that I added a pool or I did a bunch of renovations and I'm still charging the same rents, but the property value went up, right? So I can say, oh, guys, now this is a lower risk investment. So your rate of return will go lower, but that's totally fine. The buyer's willing to accept that. And I can justify selling it at a 7% cap rate, okay? So let's look at the second example. I'll just go ahead and erase everything. Okay. Second scenario, I have an NOI of $10,000, and by the time I sell, it has doubled. I did a great job renovating it, raising the rents as well. Maybe I decreased the operating expenses, whatever. But my value stays the same. Why? Because even though my NOI went up, I am selling at a higher cap rate, which suggests to the next buyer that this is a higher risk investment. So let's think about an example for this as well. Currently, you might have heard that office buildings are in a lot of trouble, right? That is because their vacancy rates are rising, right? So in that case, your NOI would not be going up for these office properties. Of course, their NOI is going down, vacancy is going up, and therefore, your property value goes down, and investors think there's a lot more risk associated with that asset class. Therefore, in order for them to be convinced to buy the property, they have to be proposed a very, very high rate of return, which is reflected by our cap rate. So with the cap rate going, your property value will go down. So they will be getting a good deal if they are the type of investor to go for really high risk things. And maybe, who knows, in like 5-10 years, if somebody bans work from home, outlaws, and it becomes illegal, everybody has to go back into the office, then now office buildings will be considered less risky and the cap rate will shrink and the property value will go up, right? So that's the relationship there. Let's see. There are some other, other than cap rate, there are some other return metrics that we also frequently use. The first one is cash on cash return, right? So cash on cash return is really asking, in terms of real actual cash flowing out and actual cash coming in, how much am I actually making compared to how much I actually spent? So if you remember, like, when you buy a property, you're spending 600K or something, right? But remember, if you have debt on the property, you're not actually spending $600,000 in cash. You might be putting up 20%, which is 120K, and then that's your actual cash outflow. And even with your NOI is not an actual cash inflow, right? You still got to subtract your, non-operating expense like capex, TIs, TIs, leasing costs, stuff like that. And then you might also have to pay your debt service, stuff like that. And then you'll be met with the actual net cash flow. So this is your actual cash flowing in. So this is taking into consideration those two actual cash outflow and inflow and your return metric there. Second one is overall over the entire investment horizon through the years. What is my return in terms of a percentage value of the project, right? So I have my initial cash outflow, and then I have my cash flows, pretend this is year 0, 1, 2, 3, and then my property sale, right? So my initial cash flow plus a big inflow from the sale of the property. So it's taking into the whole thing, translating into present value dollar terms, just like we did earlier, and then it's giving me a return. So that's what IRR is, and it's used very, very frequently. Number 3 is my equity multiple. So that's very simple as well. If I put in $100 into the deal, 100, and then by the time I exit the deal, I walk away with 150, my equity multiple would be 1.5. Okay, so that's what's going on. So that's your equity multiple. Okay, so let's see how this works. Yeah, in real life using our model.
Okay. So starting at the cap rate assumption up here, we'll go ahead and fill this out. There we go. Property value. Okay, that's pretty long.
Wrap that. Okay.
Okay. All right. So jumping right into cap rates, right? So remember our NOI over our purchase price. So what are we trying to find?
There's a twist.
Purchase price. So what are we using? We're using our percentage, our exit cap rate over in our assumptions on the left, right? So go ahead and
we gotta take our NOI.
No, I know, but focus on that cell.
Okay.
So you can see right here, exit cap rate of 7%, right? So we're given our NOI. We know our exit cap rate through just our knowledge in the field. The cap rate could be an assumption. So it's not either. It most likely will be based off of a educated guess. Is
market
honestly,
research.
Yeah, market research.
Experience.
Yeah, all that stuff. So that's going into the research of your exit cap rate, right? So let's apply this cap rate to our NOI to figure out our purchase price, right? So we're going to take our NOI.
Now, do we take our current year NOI, Mason, or something else?
So we will take our year 2 NOI. Now, the reason for this, and this is just a principle of valuation, essentially what we do here is we're saying for the next buyer, you are going to get this next year of cash flow plus whatever it may be in your terminal value. Terminal value is just the present value of all future cash flows that this property can generate beyond our analysis, right? So from, for example, year 7 to, infinity, right? Obviously that would be quite the number, but essentially what we're saying is we're trying to assume the next set of cash flows.
When the new buyer buys it, they're not going to see this. They'll see this number.
They will see the 41,000 coming in as of year 1. So we're going to use that in our analysis and say 41,000 divided by the cap rate of 7% is going to give us our sale value, right? We want to sell it to them because that is going to be their year 1 cash flow. right? So we're going to get 5 years here display of what could our value be each year. And obviously, our exit, as of our assumption, is year 5. So we're going to be seeing that $706,000 figure there. But anyway, let's go into our unlevered cash flow. Very simple. Let's take our net cash flow here. We're going to just reference that and drag it across to year 5. Bring those guys across. And we're also going to focus on our outflow, our initial outflow to the left of the unlevered cash flow. So here we're going to put in a negative 600,000 right there. Enter. And there we go. Perfect. Now, with our sale assumption, we could start using the things we learned from our Excel day. We could say if our current year, year 1 all the way at the top, is equal to year 5, then, right, comma, if it's true, what we're going to do is we're going to just select the sale value, right? And if it's false, we want it nice and pretty, so we're just going to open and close the quotes just so it's a completely blank value. Or you could put 0, whatever you like. But this is what I like, just a blank slot. So there we go, completely empty. But if we drag it across, you can see we are referencing our year 5 sale value. And you can see if we change it as well, the formula is dynamic. So sweet. Now moving to exit fees. We're going to do the exact same thing, if statement. If year 1 is equal to our exit year. Yep. Our current year is equal to our exit year. Then, if it's true, we're going to take our value, multiply it by our fee percentage, and I'll explain what fees are here in a second. So our exit cost here of 0.5%. And if it's false, we'll just do the same thing. Just put it in quotes, and bam, drag that across. There's our fee. Fees, like every transaction you have done in your life, you could also think of buying a home. There's just so many fees. Think of, let's see, like you could also consider brokers, like sale brokers. That is a very common fee.
Closing costs.
But these are all the costs associated with closing and selling the property. There's so many parties involved, so many documents. You got to pay people to do their job, right? And that's the number one cost for exit. And also your entry cost. So there's going to be around, we're using 0.5%, but this could go all the way up to 2% of the overall deal, which is just crazy. But we'll move on from that. So we'll make everything nice and clean here at the bottom. So we'll total everything up, our outflows, our inflows, and our sale value. So we're going to take, just to keep it clean, we're going to take our unlevered cash flow plus our sale assumption, subtracting out any fees. So this will be dynamic across.
Let's make it 0.
Do if error. No, you have to do if error. That's a new lesson. Go to value. No, not there. Go back. Go back to the value where it says value. Go down. All right. Now, say we got an error, right? This is a great lesson. So if we don't want it to say error or value, we could do this formula called if error. So if there's an error, right, within this formula, we're going to produce, and our example will just say 0. So if there's an error within this formula, comma, we'll produce this instead. So put a 0, and then enter, bam, and it doesn't say value anymore. It just bypasses the error, and it'll just put a 0. So now if we drag it across, we drag this guy across, we get our calculation at the far right, and we don't get those ugly value statements across each cell. So that's a very useful tool. Now, moving on from that, we can now look at our cash on cash, IRR, and equity multiple. Now, we very briefly, I guess David's refining the formula.
I'm just gonna, for the sake of our calculation, I'm gonna make this 0.
Okay. Oh, I see what you're saying.
Because error will not give us.
Present value everything down there. Yeah, I got you.
There we go.
Sweet. All right. Sweet. Okay, so let's go into cash on cash. Now, we're going to use our total line at the bottom. We're going to essentially say if year 1's cash flow, right, we want to divide this by our initial purchase price. So this is on an unlevered basis, right? So we have essentially, we're saying we're 100% equity. We've purchased this building for 100% us, no bank, no lending, right? So we're going to see our year one cash flow, compare that against our initial outflow. How much is that generating as a percent?
Hmm. Our outflow
And
is already negative, so I'm going to put a negative
yep,
sign in
put that
front of it.
as a negative. And let's see. That means we're making 5% or close to 6% of our initial purchase price off of year one, right? And we'll drag this across. There we go. So 5, 6, 6.3, 6.6.
Hmm.
So nice steady growth. Cash on cash, you typically want to see around, 7, 8, 9 is all right. Anything greater than that's super healthy. We're going to ignore the 124% because obviously
Yeah.
that's our sale,
This is
right?
driven
So we
by
don't
our,
driven by our sale.
big
So we
fat
don't have to
sale.
don't have to worry about that. Now our IRR. This formula can be complicated in so many ways, but very basic. You just got to think of this as our return on our investment, right? So we're going to consider from year zero, our outflow, all the way to our sale. This is going to tell us, considering time value money, what is our return on this investment. So go ahead and click enter. So remember when we talked about opportunity cost, this is going to be the value that you want to compare across different investments. So will my investment generate me 10%? If it is, then I'm going with that investment over this, right? We're looking at 9.1.
Hmm.
If an alternative gives us an 8% yield, we're going to want to go with this investment because it just simply has a higher yield. And then
Hmm.
lastly, our equity multiple. We want to see overall in a multiple, how much are we making on this deal, right? So we're going to take the sum of the entire, the positive range, all of our cash flows plus our sale, divided by our outflow, so our initial investment. And this is going to show us as a multiple, how much did we make? How much did we return our money? And that will be by 1.49. So there we go. One is break even for this. So if everything we did resulted in 600,000, we would just have one. But since we have return, you get that 0.5, that 0.49. So that's a very basic overview of our valuation metrics. And one thing that we'll consider in the next lecture is how debt will affect it. Now, if you take a look at the answer sheet, if you want to look ahead, there we go, the answer sheet. If you want to look ahead, right, there's a few key differences that we're going to take a look at here. So you can see below our unlevered cash flow analysis, which goes from all the way from unlevered cash flow to equity multiple. So David, if you could highlight this whole section. So this is our unlevered basis. We're going to do the exact same thing, but we're going to consider debt, right? We're going to add debt into the picture, and that's going to look like our debt service and our loan payoff. And we're going to see how does that affect our cash flows on a levered basis, right? So you can see already we have a higher return. Less cash on cash, but we do have a higher IRR. Remember, when we use debt, we could, like that double edged sword, we could either boost our returns or completely kill them. So I highly recommend that you guys look at this section, kind of find some differences, and then when we come to the next lecture, you could ask questions and we could go through it pretty quickly. But with that, we really appreciate it. Hopefully, you stuck to it until the end. I know this is about an hour, I feel like, of a video. I don't know how long we've been talking, but hopefully this was helpful and you have a better perspective on our little intro model here. Thanks.
Bye.